Hey everybody, it's Jason with Investing Unscripted, and I have the next video in our end of year series where I'm taking a closer look in my portfolio at specific groups of stocks. Today, I wanted to take a look at the highest yield stocks in my portfolio, go through some of the ones that really stand out, and talk about how I feel about the companies right now. This video is sponsored by The Motley Fool. If you're looking for even more great stock ideas, please check out our special link. Go to fool.com/unscripted. Motley Fool is going to give you its 10 best stocks to buy right now. Please check out that link after the video. All right, these are the 6 highest yielding stocks in my portfolio right now. There's one or two that might be in this mix too that I'm not including because they're really tiny companies, really volatile. They're not really large positions and relevant to the conversation. And these are the ones that I really wanted to focus on. Right at the top, NextEra Energy Partners, the dividend yield is pushing 13%. Then next we have CATO Corp, double-digit dividend. And then we have Walgreens, Boots Alliance, yields over 8.5% at recent prices, 7.5% yield from Enterprise Products Partners. Then we have EPR Properties, the real estate investment trust, dividend yield 7.2%. The bank, Truist Financial, yield 6%. Those are the stocks that we're going to talk about today. We're going to start with the highest yield. We'll talk about NextEra Energy Partners. I encourage anybody that's interested in this stock to go back and look through our videos we published on the channel. Tyler Crow and I, my partner with a lot of the videos, we've taken a really close look at NextEra Energy Partners and its parent company, NextEra Energy. And frankly, there's a lot that we don't like. This is one that I'm seriously considering selling because the reality is its growth prospects, because of the structure of its business, it's basically the financing arm for the renewable energy business for NextEra Energy, is really challenging. I can't issue stock to sell stock to use that capital to fund deals because the yield is so high. They'd have to slash the dividend to do that. And they're trying everything they can to not cut the dividend. They're still saying they can grow the dividend like 6% a year. It's beginning to look less and less like that is true. The thing that we've been calling out is the fact that as they're having to roll their debt over, as their existing debt matures, they don't have the money to pay it off because they've given all the money back to shareholders. NextEra Energy, one of the biggest shareholders in those dividends, they don't have a bunch of cash on the balance sheet to pay off debt. We're starting to see the signs of real trouble with their interest expense. For example, they just raised $750 million. They're going to use that cash, and the proceeds are around $740 million in proceeds. They're going to use that to pay off some existing debt that's maturing. Here's the thing, that $750 million they're raising, the interest rate on that is 7.25%. The debt they're paying off, 4.25%. So the interest expense is going to substantially increase just on this one tranche of debt. It's going to have to pay out more cash to service that debt than it did before. That's going to weigh on its cash flows. It's going to have to figure out how to bridge the gap. I'm really concerned they're going to have to cut the dividend. That's going to send the stock down even more. I'm trying to decide if it's time to cut my losses and move on, look for better opportunities out there. Okay, the next stock on this list, and I'm going to go through them in highest dividend yield down to lowest dividend yield, CATO Corp. If you're a kid from the South, you're probably familiar with CATO. It's a retail fashion targeting women, and it's a discount strip mall location. If there was a Walmart in your hometown, there was probably a CATO in the strip mall attached to it. It's probably still there. They have some other brands as well. Now, the stock's down. Again, the dividend yield has gone up because the stock price has come down. Why has it come down? Because the business is, I wouldn't say it's necessarily struggling, but it's declining. Like in the third quarter, revenue is down about 10%. They actually reported a loss on a GAAP basis. But if you look at the cash flows, I think the business is really secure. The balance sheet's completely fine. They actually increased working capital. Working capital is really important for retail businesses, especially because turning over inventory and generating consistent cash flows is so important to operating those businesses. It's a steady cash flowing business. It's also still a family business. The CEO, chairman of the board, John Cato, last name probably sounds familiar. I believe he's the third generation of Cato to run the company. And as of a year and a half ago, I think in March of 2022, he now owns more than 50% controlling vote in the company because of share repurchases that the company does. And if you look at their business, basically what they do is they take their operating cash flow, they pay a dividend, and then any excess cash flow they have left over from that, they buy back stock. And then lately, because the stock price has been down, they've been using some of the cash off their balance sheet to buy back even more stock. So they have a really smart, savvy way to continue to return capital back to investors. They're not being crazy about over-investing back into the business. They're maintaining it, focusing on their core and what they're good at, generating good cash flows, returning it back to shareholders. CATO is a recent addition to my portfolio, and it's one that I'm not planning to sell at all. I might actually consider adding to this position. I want to give them a couple quarters, get through the holiday season, see how the results hold up, and then make some decisions in 2024. Let's keep things going here. So I'm going to talk about next the one that I'm worried about the most, and it's Walgreens Boots Alliance. Dividend yield 8.5%. Yields up because the stock is down. Why is the stock down? Because this is a business that's really struggling, if we're honest. And they've just gone through a CEO change. Roz Brewer, who had been the CEO for the past several years, came over from Starbucks in an attempt to turn the business around, help them really focus on building out the healthcare services business, the Minute Clinic kind of thing inside the stores. And they've really struggled with that. That business is burning a lot of cash and not making money. The retail pharmacy business is not doing great right now. There's some really big incumbents and also some upstarts that are entering the business. Think about Amazon, but between Walmart and CVS, there's a lot of challenge already. And they have a new CEO that's come in. He's got a healthcare experience background. I think that's really valuable. So he could be the right person to turn it around. I'm just not sure I want to participate in that. I thought this was a great value opportunity and a turnaround play built in together, and it turned out to be a value trap, and I've been wrong. Trying to decide, time to move on, or do I want to give this new manager a chance before I sell? I'm leaning towards selling, but I want to be patient and give this new guy an opportunity to see if he can earn my capital before I make a final decision. What's up next? Enterprise Product Partners, dividend yields about 7.5%. This is basically the exception on this list of stocks that have a high dividend yield because the dividend has generally moved higher. Enterprise Products Partners, of course, the midstream giant, lots of pipelines, lots of gathering for natural gas liquids, so things like propane and butane and other natural gas liquids that are used heavily in the petrochemicals industry to manufacture like plastics and fertilizers and all kinds of things like that. Dominant business. You make your money on the dividend here. They grow that dividend modestly every year. They've been able to accelerate the dividend growth. This is a stalwart. This is one of my foundational dividend investments. It's a partnership, a master limited partnership. So there's some quirky tax rules that are worth understanding. If you're interested in it, make sure you understand those tax implications for owning an MLP before you move forward on that one. Let's move on to the last two stocks here, EPR Properties and Truist Financial Corp. So EPR Properties, of course, is the real estate investment trust. They own properties that are mainly targeted like experiential things. So movie theaters, they have a big exposure to movie theaters. They also own a lot of Topgolf properties is one of their big tenants. A lot of their core business is pretty e-commerce resistant, pretty safe. Again, because it's experiential, but that theaters business continues to weigh on the business. It's a massive part of their rents. Probably the biggest risk, I think would be a good way to describe it. It's a pretty low probability at this point that it would harm them. They've already had one of their tenants went through bankruptcy about a year ago, and they came through it basically unscathed as part of the bankruptcy. Their rents and their contracts were relatively unaffected. And I think if we were to see maybe AMC potentially go bankrupt, that's a pretty large customer of theirs. I don't think it would really affect EPR as much as a lot of people would expect it would, because, well, EPR owns a lot of their really important properties. And again, the rates seem to be good, fair market rates, and it would be unlikely that they would see a big cut in the rents that they would have to pay, barring a liquidation situation where AMC would be closed down and liquidated. It just seems unlikely that would happen. I'm pretty comfortable holding EPR. I think they're managing the risk really well. And a lot of their other businesses are in growth mode, and I think that's a really healthy thing to own in a dividend growth portfolio. Take a little bit of risk with the upside, I think is well worth it as part of a diversified portfolio. Then Truist Financial, this is the bank with the highest yield. It's over 6%. A lot of that, again, is because bank stocks are down. Truist Financial is not one of the too big to fail banks with higher regulatory scrutiny and reviewed that are super duper safe. It's just below that threshold and is potentially facing some additional regulatory requirements that could raise additional expenses. There's some of the bank regulators have talked about requiring some of these banks to add additional debt as capital to help protect depositors. And that interest expense would cost more money, right? To have to service, take more money that could potentially be given to shareholders in dividends and profits. So that's part of the reason that the stock has come down, and there's still some worry about that. Rising interest rates on higher yields on their deposits. It owns a big book of fixed rate mortgages that are yielding lower than you can earn in a high yield savings account from an online bank. So there's some challenge there to make sure it keeps a healthy, low cost deposit base while still dealing with those low yielding mortgages that it has as it adds more and more loans at more market rates today. So I feel pretty safe with Truist. I don't feel like there's any concern for depositors running the bank. It's a safe bank. It's well run. I feel like their loan portfolios are safe loans. These aren't risky loans that it has. They're just low yielding, low returns in this higher interest rate environment. So you put it all together. Again, Truist, this is one that I actually added. March and May is when I was looking at buying Truist when bank stocks were down the most. I've actually done well on the stock. It's come up since then. And that yield is secure. The dividend yield, I think, is pretty secure and safe. Again, barring regulators for some reason making some of these banks reduce their payouts, which they have the power to do. I don't think it's a very high probability that happens. Things you need to know, though, when you're owning bank stocks. I'm going to pull up this list and share my thoughts again, starting with NextEra Energy Partners. The yield is high because there's a good chance that dividend gets slashed. They're saying they still can grow it. I'm very far from certain about that. It's on my maybe I need to sell it list. Next is CATO Corp. This is recent addition. This is on my I may be buying more of this one in the next 6 months list. Family owned, very well run, cash generative, super safe balance sheet. Walgreens, also on my maybe time to sell list. I'm going to give the new CEO a little bit of time, give him a couple quarters to see if they start getting their financial house in order. Enterprise Products Partners, foundational stock in my dividend portfolio, not selling it. I think it's a buy. EPR Properties, risk reward, exposure to the theaters business, concerning for a lot of investors. I think it's probably less risky than most people that are worried about it think. And then Truist Financial, I think this is a good high yield, safe bank stock to own, but it's a bank stock and all of the cyclical risk that comes along with that and the leverage risk that comes along with that. Make your own decisions about any of these stocks, whether they fit your portfolio or not. Share some comments. If you have questions about them, you have your own thoughts, I'd love to hear from you. Check out our special link, fool.com/unscripted. The Motley Fool is going to give you its 10 best stocks to buy right now.